So today we're going to talk a little bit about operational financial modeling. I'm sure there are some of you that took liberal arts and anthropology in undergrad, and others have probably done some investment banking work and worked at Goldman Sachs in a previous life. So we're going to try to make this, one, entertaining, right? We want this to be fun. Finance is one of those boring topics, so we're going to try to make it a little bit entertaining. And two, we're going to send out a couple of polls initially, so we can actually try to gauge the audience as to kind of where you're at in terms of, have you done financial modeling? You know, what is cash burn? What's the
most important metric for
exactly.
financial models?
All right, so while you guys are doing that, a little bit about us. We do work with a lot of venture-backed and, of course, traditional operating companies throughout the United States. We have over 250 customers. We love the venture-backed. The reality is I spent 15 years in corporate America, and when I left in 2012, 2013, I had folks around me that said, oh, Dan, you know, there's this whole world of startups. And I was like, what's a startup, right? I was used to capital markets, used to like investment banking, a whole different world. And what I love about startups is you guys need a little bit of everything, right? And but at the end of the day, founders and management teams need to stay focused on product development, customer acquisition, go-to-market strategy. Those are really your important things. And of course, being able to raise capital to fund your grandiose plans. And so in 2014, after working with some of my close mentors, we decided to buy an accounting business because we're not CPAs or are not accountants. And we really had this sort of vision of working with small, medium-sized businesses around their accounting and finance value streams. And several years later, we're kind of referring that as a finance as a service company. So, and Corey, you've actually been here since you were interning back in when you were a sophomore many years ago. And so Corey's kind of seen us in our growth. And
almost as a startup working on startups.
Exactly. So before I move over to the next slide, I know everyone is still answering some of the polls.
So it looked like the last one, poll number one, which was, have you ever built a financial model before? It looks like about 75% of you said yes.
Good.
25% have not yet. So good baseline to kind of, as we go through this, we'll probably skip over or speed through a couple things.
A couple of people describing the difference between cash versus accrual. You know, this is not going to be an accounting 101 class, but it is so critical as you're building out financial models to understand the journey of revenue, the journey of expenses, and how some revenue and some expenses don't actually translate into cash, right? Or other expenses actually translate into cash much earlier than when they actually get recognized as an expense on your P&L. So we're going to kind of take you through the cash journey and the accrual accounting journey in our financial modeling hour here.
We'll have a couple personas for people to help kind of elaborate the differences between
right, because you know, one of the things I'm sure you're learning about is the plethora of many different business models that are out there. And every business model has very unique sort of patterns of accrual accounting and patterns of cash. So this next question is actually quite important too, because you know we've tailored the next 60 minutes or now maybe the next 50 minutes for startups and those that are with the mindset of raising capital through venture capital, angel groups, friends and family. So I'm with you guys. If I were to answer this question, not in this session, I think that net operating profit, NOP, is the most important metric. But in this world, in the next 15 minutes, it's really about your cash out date, right? It's your cash burn. Because without cash, cash is that key resource that helps you achieve the goals of your plan, whether it's goals over the next 12 months, 3 years, 5 years. It requires capital to achieve those goals, to build out your the scaling of your business, building out the company, acquiring new customers, product development, building out inventory, right? Because in the first year or two, for most startups, most don't even fathom actually even making profit, never mind free cash flow. So that's good. I'm glad we put these polls out. Cool. So with all that said,
So kind of set the baseline now. You made a comment. We're not here looking at this through the lens of accounting, through the lens of GAAP accounting, making sure that, debits and credits, right? But at the end of the day, we are building financial model, right? We are building a P&L, a balance sheet. So why do we build them? Like, what is the purpose of it?
So whether it's in the last week or two during your startup boot camp, or as you're out there, a more mature startup, whether you're pre-revenue, you've raised some money, you're always iterating and you're always trying to answer questions. And you probably are able to answer these questions, is why you'd have a startup. What problem am I solving for? How big is the market? Who's my customer? My value proposition, how do I actually price that out, right? That's more of an art than a science. How much can I actually sell? All of these basic questions that many of you probably, have in the back of your mind, like, where am I going to make it? Do I hire people? Do I do software engineering, software programming in the Ukraine, or do I hire here domestically? These are all questions that you guys have most of you can probably answer 80% of these. Why do we do financial modeling? Well, it's to bring a lot of the answers to these questions. It's to begin to bring them together. And so I would say, everybody hears me say this like at least once a week. Financial modeling is all about grounding your story, right? All of those inputs, so all of those questions that you have about customers and markets and product development, the scaling of the business, that is your story. But a story needs chapters, right? A story needs organization. And for better or for worse, the accountants, financial professionals have created this sort of financial statements. And financial statements it's sort of like, it's a pattern that the investors, the market, the bankers, people understand. They're able to talk accounting. And so grounding your story in financial models. I kind of put this little diagram off to the side because, if you're not a startup, financial modeling is still important. It's the basis of communicating to your bankers, to your employees. And it also allows you to manage and track performance metrics. It allows you to raise capital, do a little bit of scenario planning, especially in times of COVID and the Great American Shutdown or the Great Global Economic Shutdown. Scenario planning became sort of back in vogue in the summer. It also helps you understand leverage and other financial performance. So,
if I'm hearing that correctly, then it's less so about getting year 5 numbers correct or year 2 through 5 numbers correct. It's more so, how does it tie back to the operation?
How does it connect the dots of your story, right? That is critical. And why am I spending a little bit of time on sort of very high levels? Because for many of you, financial modeling just feels foreign, right? It's numbers. I'm not comfortable with it. I really just want to focus on my customer acquisition, product development.
Just feel like you're just doing it just to get it to an investor.
But it's one of the most powerful things that you can do because it brings everything together. And then ultimately it sets a bar. It sets that line in the sand that you begin to manage against. Mm-hmm. So with all that said, it's about connecting the dots. And I would say the last thing here is, as we're kind of going through this, because that last poll about cash burn is very important. Remember, profits do not always equal cash, especially in the world of a scaling, emerging growth type of company where you're burning more capital than what I like to call the flywheel of a sustainable business, right? It's predictable. Startups are not as predictable because as you're growing, that 1-2 steps forward may require an extra 100,000, may require an extra $1 million to fund that. So most importantly, stay focused on cash and know your cash burn, okay?
And it kind of comes down to your point, to kind of reiterate that, it comes down to the different business model, right? The different revenue models, which kind of on our next slide, we'll kind of outline what those personas are that we're going to talk through the lens of today.
Right, and the reason why we did this is because, business models, and in other words, the word business model is overused sometimes, but let's call it the way you make money, right? The way you make money is changing. The days of an exchange of value for a dollar or for a currency immediately, that immediate gratification, that is changing. Today, we see a lot more companies that are doing SaaS, right? monthly recurring revenue, or they're collecting they're collecting 100% of the capital up front. So the business models are changing, and so as we kind of going through this, we're like, okay, how do we get everybody to get the most out of this? Because it is not a small intimate class. And so we decided to go with these three very, very high level personas. Okay. So Corey, you want to run us through a couple of these?
Sure. So we'll start with SaaS because that's probably one that we are seeing more and more. But SaaS, kind of some of the revenue models of that characteristics are obviously the monthly and annual contracts, right? This is going to be much more an emphasis on that cash versus accrual, right? It's depending on if it's monthly, annual. A lot of the emphasis during these models where you'll spend a lot of that operating expenses is coming around that software development piece of this.
And you'll hear us talk a lot about what is my product development roadmap, what is my technology roadmap. I'm going to take one step back. As I approach financial modeling, I always ask the companies to put over time a roadmap, very high level. What are some of the goals? And what is the cost of those goals? So as we're going through this, the emphasis here, software development for a SaaS business, it could mean that I have to spend $5 million over the next 2 to 3 years building out a platform so that I can actually start converting into revenue. And that's where the bulk of your fundraising will end up being focused on. And
once again, tying back to the operational strategy and grounding it with the numbers.
Now, one of the big business model sort of emphasis around SaaS is the collection of cash up front for the rendering or the rendering or the delivery of service or product over the course of the next 12, 24 months. So they collect $1,200 up front for the use of a system over the next 12 months. And how that interacts in accounting and cash is very different, okay? So deferred revenue is a big piece here that we want to touch on. So let's talk about DTC. What's DTC?
So direct to consumer can mean a couple different things, but what we see often is kind of that Shopify model, right? People starting their own business, right? We've seen it a lot through the pandemic, right? People selling masks on Etsy, Shopify, Squarespace, more so direct.
Circumventing the traditional retail channels, right? We're seeing a big push into that, whether it's clothes in a box or my shaving and my razors in a box, right? It gets delivered, or even my toothbrushes. This is becoming a very big model too. And so where is the emphasis on the DTC model?
It's mostly around the product development and inventory. And that's where you're going to spend a lot of the time. You'll see it in the accounting implications as well. That's where you're going to spend a bulk of your focus, right?
Inventory build out and marketing, right? Customer acquisition costs. This is where you start hearing about things like customer acquisition costs, lifetime value. So in the beginning, the emphasis is on product development and the build out of inventory, then ultimately leading to marketing. And so the next piece is, this is going to be the more boring sort of business model, more traditional. Kind of looks a little bit like us in one way or another. So this is a service-based model, and that can be everything from restaurants to
mechanics to anything. This is one that you'll see. This is kind of human capital intensive. Thinking of it through that lens as well. It's a high emphasis on people, scaling headcount, payroll allocations.
And so one thing that we are going to talk about here is understanding the financial and capital strategies. Like ultimately, where does this lead us based on these personas? You know, again, generally speaking, guys, the SaaS model will have a higher gross margin, which essentially leaves a lot more capital below the line in operating expenses for things like blowing up your marketing strategy or hiring people. And the DTC models will tend to be a lower gross margin, right? Because you're selling hardware. And then ultimately the service-based model will be that 50 to 60% gross margin, or even 40 to 60, depending on what industry you're in. So that's kind of a pause here. This is our three personas. And as we go through this, we want to be able to connect to these three. With all that said, feel free to ask any questions. We are watching the chat line, so let's jump right into it.
Cool. So review with the financial statements.
So 2/3 of our participants, they kind of know what accrual versus cash is. They probably built the financial model. So I'm going to spend a couple minutes on this just to make sure we're all on the same page. So the P&L, that's your income statement, right? And then you have your balance sheet. Now, Corey, one particular statement or schedule, because it's not a true financial statement, one schedule that's not on here, that's very critical to start up financial modeling, that's your direct cash flow, right? So as we look at these two, we're looking at them through the lens of accrual accounting. In other words, a dollar of revenue or a dollar of cost of goods sold may not actually translate into a dollar coming out of your bank or into your bank account, right? So I like to look at my direct cash flow model as sort of the ebbs and flows of physical currency in and out of my account. And we're going to take a peek at a real life example, but let's start with the P&L. You have your revenue, you have your cost of goods sold, right? We've left labor, materials and packaging, freight and delivery. You can even throw in there Amazon AWS services, right? Especially if you're a SaaS-based platform. That leaves you with your gross profit. You've got your OpEx. I'm keeping it very high level here because as we're going through financial modeling, one of the pitfalls I see with many founders is they sweat the small stuff. It's the 80-20 rule when it comes to 5-year modeling. One thing I will guarantee everybody here is you will get it wrong. It's always going to be wrong. You're never going to be 100% correct. So don't sweat the small stuff. Get what you know, what you feel strong about through voice of the customer, voice of the market, your pricing conversations, your value proposition, benchmarking with other founders that have gone through this, using that data to build out your financial model. If there's one thing I want everybody to kind of get out of this, and I tell this to all of our team members, is demystifying the process of financial modeling. It doesn't have to feel so stressful. I think it feels stressful when people sweat the small stuff.
Or when they're trying to, it's that balance between accuracy and precision, right? It's like
directionally accurate. That's all I care about, right? I always say that. So, right, Corey. So that leaves us with operating expenses. So, guys, I look at gross profit as whatever is left over after I collect my revenue and the costs associated with rendering or delivering that service or product. That's what's left over for everything else, including your paycheck, including more scaling of the business, including enhancements to product and additional geographic expansion or market expansion. And so, as you're a startup, that revenue minus cost of goods sold equals gross profit. Just because you're a startup, that gross profit should still really be positive, right? It doesn't have to be achieving industry standards, but it has to be
on an accrual basis.
On an accrual basis, it has to be positive. On a cash basis, it'll never be positive, right? On an accrual basis, it has to be positive because what's left over, that's what you're going to use to build out your team, okay? And so in most startups, that net income or that net operating profit will 9 out of 10 times will be negative. And that's really sort of directionally the capital that's required to continue feeding the beast, right? Continue pumping cash into this machine in order for you to achieve your 3 to 5 year targets. Your balance sheet, the reason why we're going to touch on the balance sheet, because it has one of the most important assets on there, which is cash. Accounts receivable, some of those personas are actually never going to see accounts receivable. It's very rare that a SaaS-based company is going to have an accounts receivable because what ends up happening is when you go onto their website, for example, and you sign up for that service,
you can't even use it.
You're going to start paying right away, right? Inventory, many of those personas are never going to experience inventory. Service-based businesses may not have inventory, but inventory is a critical component here because inventory is cash, right? Now, the balance sheet is where you start seeing the cash movement. And I'm emphasizing that because when we begin to bring this all together, you're going to understand the difference between an accrual P&L and then a direct cash flow model, which is how you raise capital. It's through that direct cash flow model. And then lastly here is the liabilities. I wanted to just throw out the deferred revenue because again, this is an up and coming, it's a very prominent, ubiquitous account in the chart of accounts, especially with these new business models.
So you're even seeing that deferred revenue though in things like Walmart, right? They have a new subscription, right? So you see it more and more. But I think to summarize kind of some of the things you've said through this, it's not so much looking at this through the lens of this is the go-to financial statements, but it's more so how can you think of your business on the high level operationally, right? These accounts are going to change, right? And it may be different for every business, but thinking through the lens of what is the basis of my business? What is the foundation need? What are the moving parts, and how do I tie my strategy back to numbers to ground it? Right?
And we purposely like to show very simple, high-level financial statements because you can really spend a lot of time in the weeds filling in the blanks underneath G&A, R&D, sales and marketing, phone expense, right? Keep it high level, try to fill out these categories at the high level, and then begin to drill down into these categories. So let's kind of move and go to the next slide. So here at GrowthLab, we've spent a lot of time on business modeling, I would say, or financial modeling. I would say 8-9 years ago, one of my first customers was all focused around business modeling. And business modeling and financial modeling for me coming out of corporate was sort of intuitive, right? We understood it, but when you get into the startup world, you know, it feels overwhelming. So we kind of came up with a really quick 10 steps. And some of these, you're probably scratching your head like, wait a minute, these are finance accounting guys, why are they talking about strategic marketing? Why are they talking about customer segmentation? Because, you know, that's where it all starts. If we go back up to the top of an income statement, it's revenue, but it really isn't revenue. It all starts with your addressable market. So all of the things you guys were learning over the last week or two, this is where it starts to come together. It always starts with your addressable market. How big is it? How many marketing dollars do I have to target that addressable market? What is my conversion rate on my marketing dollars, your ROI, right? So thinking about these things, it starts at the top because revenue equals what? Price times volume. Volume is essentially how much of my addressable market can I capture? Number two, I actually throw in number two as customer acquisition costs and not pricing, right? Because one would say, well, customer acquisition cost, that goes below the line. That's like a sales and marketing expense. It is and it isn't. It actually is on an accrual, on an accounting financial statement. But thinking through it, remember, you need to be able to raise capital to go and acquire a customer. You don't have endless dollars to market with. Capital is rationed. And therefore, if you were to raise $500,000 or $5 million, there has to be a portion of that monies that is used for my go-to-market strategy, AKA my customer acquisition cost, okay? So I've got my addressable market. I start to figure out what my customer acquisition costs. So I'm gonna just deviate for just a second. So Corey, how do we figure out what my customer acquisition cost is, right? That's like $1 million question we get all the time. But someone told me you can't put that in, it has to be that, right? I like to say your customer acquisition cost it's what you want it to be from one perspective. There are many things that go in and out into customer acquisition cost. Just make sure you detail out what you've included. This is your story. This is not just a series of algorithms that somebody gave to you and says, okay, customer acquisition cost has to equal this, this, and that. It can only be search engine paid ads, right? It's not. It can be more than that because it's really a function of your business. If I'm a SaaS enterprise business versus a SaaS be to small business, your whole sales cycle looks a whole lot different and the structure of your sales team looks different.
Once again, it kind of goes back to what I'm hearing from you, Dan, is it kind of goes back to less about getting it perfectly accurate and coming back a year from now and saying, I got that number exactly correct. It's more so, does my strategy make sense in order to acquire those customers? Because the numbers will always be off.
Right, so we go back to addressable market, customer acquisition cost. And now we go to number 3, which is defining your pricing strategy. What are you going to be selling your product or service at? And how are you going to collect the cash from that pricing, from the sale of that product or service? Number 4, it's that revenue model, right? That's the revenue drivers. That's
tying these pieces together.
You're starting to tie these pieces together because number 4 is the top of your income statement, okay? Now, the big question is, now that I know my revenue, what did it cost for me to actually deliver that product, for me to make that product, for me to deliver that service? And it really comes down to, I mean, let's face it, most startups are not creating their own manufacturing lines. You're going through co-packers, you're going through contract manufacturers. So the world of like how you actually build a product today looks very different from 10, 15 years ago. So number 5 is all about understanding the cost of your product and service. And here it really is going to be a function of your business. So going back to the personas, SaaS versus service, right? In order to deliver a service, chances are, I would say 30% of the cost of your service, right? The revenue that you generate from your service is probably going towards people, right? So there's a labor intensive piece to the service side of the business. Whereas the SaaS, you're probably going to have a whole lot less cost of goods sold, right? You build a platform and then you have to host the platform, to be very simplistic.
And I think there's enough, I think something that we talk to customers about often is your business model may be completely different, but there's enough data out there to at least get a benchmark, right? So you threw out that 30% number for the service-based business. That's not a golden rule, but it's a benchmark that you can come back to the table with.
Yeah, it's a pretty good benchmark for service-based businesses. So now that we've defined our revenue, how are we going to generate that revenue? How are we going to collect that revenue? Yeah. And then we figured out the cost of goods sold, what is it going to cost to actually build it? And how much inventory do I need if I'm an inventory intensive company? Now you've got your gross profit. Okay, so now that we have our gross profit, we begin to think about how do we build Rome? Well, most companies, we begin the scaling process through building an all-star team. I like to look at team and the team development, team acquisition, back to my timeline. I always say put year 1, 2 through 5, and the different functions in the team. And for many companies, the first function is probably going to be software engineering, right? Software development. Then maybe marketing, and then sales, and so on and so forth. I like to see the time periods with the functions and who you're going to hire and when at what cost. If you begin to lay out that matrix, that two-dimensional matrix, time versus function versus who you're going to hire and when, that begins to build out the whole team piece of the payroll and wages. Now, one little other caveat in 6, building out the all-star team. For financial modeling, there's this thing called allocations, right? Many companies want to be able to say, okay, my management team and my accountants and my finance people, they're going to go in G&A, right? That's general administration. But my product development folks and my software engineers, I want them under the R&D. Or I happen to have customer success people. I want customer success and customer onboarding to be in cost of goods sold, because without them, I couldn't actually deliver that service or product. So how you begin to allocate the cost of your team, that's really up to you, and you have to be able to, again, communicate that. So 7, operating expenses. 8, timing. It goes back to timing. Timing is of the essence, because things never happen on day 1, and you've got 5 years to scale. Things never happen as fast as you think they will. So thinking about the actual bringing on of team members methodically, sequentially, and basing them on either revenue targets or product development goals is a great way to start. So I go back to that time, like the time series.
And to repeat that, it's less about hey, I'm going to hire someone every 6 months or on mark 3, 4, 6. It's more so when X happens, then Y happens, right?
Right. Good. So timing is of the essence. And then it comes down to, it's all about the burn, right? Knowing that cash. You have revenue, and you collect that revenue. You have your cost of goods sold. You pay your vendors. Leaves you with your gross profit. You've got your operating expenses, your people, your building, your whatever else you may have in operating expenses. And whatever's left over is your net income. And in many personas, in many business models, that net operating profit is pretty close to your cash burn, and depends on the business. So we're going to kind of run through a couple of these and over the next few slides. And I want to actually run through a real business model from 4 or 5 years ago. This business model, this business it's actually interesting because it sort of transcends these 2 or 3 personas that we're outlining. It's both a hardware company, it's a SaaS-based company. Some of the SaaS contracts are collected up front, others are collected month to month. And then there's a consulting piece to this as they were working with large national OEMs. So,
or even that customer service piece of it too.
yes, and it has the customer service piece. So this is where we all start. How big is your market? Again, these are things that you probably have started to cover over the last week or two. Your addressable market. And again, there are many ways to kind of skin this cat. I'm sure there are, over the years, there are other approaches, but I like it linear. Addressable, target, penetrated. I like this because you start with an addressable market, right? That is the total potential. But if I only have $100,000 in the bank to spend on marketing, I can't really afford to spend $100,000 to attract 100 million potential customers. It's just not going to work. So I got to be able to surgically identify the segment within that addressable market that I'm actually going to be able to target with the limited dollars I have in order to maximize my ROI.
And I think that's to touch back on the last slide, which was point 10, start back from the top. It comes back to, because if you are selling t-shirts, for example, and that price point comes out to $100 a t-shirt, your penetrated target market is probably going to look a little bit different.
Your target market will look very different, right? And so with that, you kind of have your penetrated market, in my mind, is essentially how much you're going to sell of what you're going to sell, right? So in years 1, 2, you're sort of slowly ramping up. Nobody ever goes from 0 to 60, or we have a couple of folks from Europe. We're never going to go from 0 to 120 kilometers an hour. So, you got to be thoughtful, because that has to come back to my marketing budget, because you need to be able to defend, right? You need to be able to justify that with $100,000 of marketing budget from my first raise, I can go out and market to 10,000 potential customers, and I expect to gain 1,000 customers. Okay, that's a 10-to-1 conversion. Great, 10-to-1 conversion. I spent $100,000. That's about $1,000 a customer. That's my customer acquisition cost, is $1,000. So that $1,000 needs to go to my operating expenses. So I say, put that in your back pocket, because in the next 2 slides, we will address that. But it's important to start there, right? That's step number 2 in our 10 steps. So we got your volume. Now we talk about pricing model. That's the beginning of your unit economics, right? Am I paying per transaction? Am I paying for a month? Am I borrowing your service? Am I borrowing your product? Is it an Uber ride, right? Pricing models have there's a million ways to slice and dice a pricing model. Just make sure it's a pricing model that is justifiable, that is grounded in good research, voice of the customer. You hear about anchor customers, right? This is a great place to start that conversation. So once you have your volume, you've got your pricing, chances are, depending on the type of company, you're going to have some discounts and returns. But I would say, for the sake of a startup, you kind of don't really think about the discounts and returns. Processing fees, I got to tell you, that's a little bit of that 80-20 rule. Everything has a processing fee. You use 2% on a credit card transaction, or 2.5% if you want to go on the high end.
Goes back to using benchmarks. Don't over trivialize this.
Yeah, you go ahead and you put it in there, but again, it comes down to that processing fee line item in your financial model is not going to make or break you. It's not going to be the key to funding.
And if it does, then there's other issues.
Right. However, shipping and handling is a big piece, because whether or not you're able to pass on the cost of shipping, handling, you don't see as much anymore, but to be able to pass on that cost, that's critical. But most of these companies we're seeing, it's about creating a frictionless environment for the customers to transact. So you're seeing a lot less of this shipping and handling on the revenue side. And so with that, we're going to jump right to cost of goods sold. So now we've kind of defined our revenue, the drivers of the revenue. Now we're going to start talking about cost of goods sold.
What do we need to actually service that revenue?
Right. And again, you see here years 1 through 5, when we actually build some of these models, depending on who we're working with, you can do this by the month. But I always tell startups when they say, hey, I need your help to do a business model, a financial model, I say, you know something, you should actually do it yourself. Don't go too much into the weeds. Don't be thinking about 12 months, 24 months, 60 months. Think about it on a yearly basis, because you can always begin to break that down as time goes on. So on the cost of goods sold side, we talked about materials and parts costs, right? Again, this is not translated into cash. This translates into expenses, accrued expenses. You have your unit direct labor costs. Service-based business, if I charge $1,000 for a project and it costs me, say, 5 people hours, and I'm paying on average $50, that's $250. Subtracted from the 1,000 my revenue, that's at 75% gross margin, right? That labor cost has to be inputted into the cost of goods sold. Freight in costs, freight out costs, you see more in that, especially in the DTC world, where companies are now in the business of distributing and fulfilling, whether it's subcontracted, but they're actually doing it, right? They're not going through retail channels and wholesalers.
Or even Amazon, the selling through Amazon. You see that more and more.
Right, so that's another thing that we didn't put on here. For a DTC or e-commerce that's using Amazon as the fulfillment platform, there is not just the fulfillment cost, but there's also some component of revenue sharing that technically should be in the cost of goods sold. So, cost of goods sold subtracted from revenue gives you your gross profit. Cool. Now we talk about operating expenses. Remember the customer acquisition cost I said put off to the side? This is where it starts to come back. In my marketing budget, if I acquired 1,000 customers and it cost me $100 to acquire those 1,000 customers, my marketing budget, being very simple here, right? Very high level, my customer acquisition cost, my marketing budget is 100,000. That's the number I would expect on here. And that's important because remember, financial models are not just iterative, but they're so intertwined and interrelated. One lever drives another. It would not make sense for you to talk to an investor and say, my customer acquisition cost is $10, yet I have $1 million marketing budget, and yet I've only acquired 1,000 customers. Like, you try to triangulate that, it just doesn't make sense, right? So as you're going through this process, think about the impacts of these different numbers and drivers that they may have on other numbers in your model.
And how would customer acquisition cost in a 5-year model like this, does it change through the years? And if so, how could it change?
So what I've seen is customer acquisition costs tend to be across the board understated. Acquiring a customer is not easy. And all too often we underestimate it, especially in the early years. So in the early years, chances are you're getting into business because you may already have an anchor customer. There's an affinity with with a particular market, this niche. But as time goes on, it becomes more difficult to attract that next customer. And then what we end up seeing is by year 3 and 4, the customer acquisition cost starts to come back down because of economies of scale, exponential, word of mouth, right? Branding, right? All of those things start to come together. But one of the things you mentioned, Corey, is, Facebook, not to plug in some of these names, but Facebook does a beautiful job of giving companies insight into what it costs to target a particular customer group and what the actual conversion rates could be coming out of that.
As those benchmarks. So
for most of you that don't have businesses, I would say sign up for Facebook Business, right? What is it called, Corey? You're more familiar with this.
Like Ad Manager.
Ad Manager for Facebook. Sign up for Google Analytics and Google AdWords, right? Because there's a lot of benchmarking data that's in there. So when we want to set up, and I'm deviating here and I apologize, but it's so critical, like for this customer acquisition cost, because a lot of what we do today, it's marketing online. It's all digital marketing, and understanding what that customer acquisition cost is, that's the difference between raising 1 million and 10 million, right? And how efficiently effective you're going to be with that capital on your marketing budget. So
spend $100, trial it, run it.
That's another thing we always recommend is spend $100 on Facebook Ad Manager. And
test it out.
Test it out. You know what your demographics are. You know your addressable market. You know the personas you're trying to attract. Go onto Facebook. They slice and dice the entire world. I can go on and on about the go-to-market strategy costs, but critical piece of your operating expenses. And then we talked a little bit about the headcount. Again, headcount, you can allocate headcount dependent on the function that they have in the company. Personally, I always like to take my headcount and allocate the component of headcount that is attributable to the sales and marketing effort. I like to allocate that into my operating expense, into my marketing and sales operating expenses, because sales and marketing it can suck up a lot of capital, right? And so we want to be able to manage that. And so
this next slide is going to be a little bit more about that that service-based business, that footprint and that direct labor.
Although footprint, this deck was actually made about 2 years ago. Footprint, for better or for worse, is becoming a whole lot less relevant in business, especially in some of these personas. But yeah, definitely, Corey, in the service-based business, footprint is still very important. But we're seeing a lot of that, even things like warehousing and fulfillment centers. A lot of the DTC startups, a lot of this is all contracted out, or co-packers that have fulfilling capabilities, but still needs to be captured here. Direct labor headcount. Here's another one, right? So this is where I take, again, that headcount, and I like to apply or allocate that portion of the headcount that is related to specific functions, right?
Sure.
If I'm a SaaS-based business and I have a data analytics component to my SaaS-based business, and I need to hire data scientists and data analysts, I want to be able to stratify or bifurcate that from the rest of the people that we're hiring, because it's such a critical piece to the growth and value proposition of the business. And so the last of the headcount, or the last of the overhead. We spent a little bit of extra time on the overhead, because this is where we do get a lot of questions. What should I put in? What should I put in? Try to keep it high level again. Okay. So management, other headcount, your leadership team, accountants, IT, things like travel and entertainment, general corporate expenses. 80-20, right? I wouldn't be sweating this too much, because again, this is not.
You can't tie them back to the operational strategy, right?
To the goals of the business, right? And lastly, it's a little bit more of the other stuff where we tend to spend some time. Again, this is the small stuff. Don't sweat it. Don't waste too much time here. Cool. All right, final thoughts. And I want to jump into a model for 5 minutes. I want to take you on the financial model journey. You're going to see things kind of come together.